For decades, Dubai's skyline has symbolized ambition, wealth, and limitless growth. Towering skyscrapers, luxury apartments, and dazzling city lights transform the desert into one of the world's most recognizable urban landscapes. But tonight, a different story is emerging. Reports from across the city suggest that occupancy rates in several residential and commercial developments have fallen sharply, raising questions about the sustainability of Dubai's relentless construction boom. Entire districts that were once marketed as the future of luxury living are now facing increasing vacancies. In some buildings, rows of dark windows stand in stark contrast to the bright promotional images used to attract investors from around the globe. The issue isn't simply about empty apartments. It reflects deeper concerns about supply, demand, investor confidence, and the changing dynamics of global real estate. For years, developers raced to build bigger and taller. New projects launched at a breathtaking pace, often before previous developments had fully matured. While that strategy fueled growth during boom years, market analysts now warn that oversupply could be creating serious challenges as occupancy levels decline. Property owners may face falling rental income, while developers could struggle to maintain pricing power. The image of endless growth that helped define modern Dubai is now facing one of its toughest tests. And as more data emerges, investors, residents, and policymakers are watching closely to see what happens next. To understand today's situation, we need to look back at how Dubai became a global real estate powerhouse. Over the past 20 years, the city attracted billions of dollars in foreign investment. Buyers from Europe, Asia, the Middle East, and beyond poured money into luxury developments, seeing Dubai as both a lifestyle destination and a financial opportunity. Developers responded aggressively. Massive residential communities, waterfront districts, office towers, and luxury resorts appeared at an extraordinary pace. Each new project promised higher returns, better amenities, and even greater prestige. During periods of strong economic growth, this model worked remarkably well. Population growth increased demand. International businesses established regional headquarters. Tourism surged. Property values climbed. When construction outpaces actual demand, vacancy rates can begin to rise. This phenomenon is not unique to Dubai. Major cities worldwide have experienced similar cycles, where optimism encourages excessive building activity. Recent market indicators suggest that some areas of Dubai may be entering that phase. Thousands of new residential units continue to enter the market while competition among landlords intensifies. Renters now have more options than ever before, giving them greater negotiating power. At the same time, rising global interest rates and economic uncertainty have made some investors more cautious. What was once viewed as a guaranteed growth story is becoming increasingly complex. The challenge facing Dubai is not whether people still want to live there. The question is whether supply has expanded faster than demand can realistically absorb, and that distinction could shape the city's next decade. Occupancy rates are among the most important indicators in real estate. When occupancy remains high, landlords generate stable income, property values tend to hold steady, and developers gain confidence to continue building. When occupancy falls, the situation can change rapidly. A growing number of vacant units means fewer tenants competing for available space. Landlords may be forced to reduce rents, offer incentives, or absorb extended periods without income. In Dubai, concerns are growing in specific segments of the market where new supply continues arriving faster than tenants can fill it. Luxury apartments, premium office spaces, and certain newly developed districts appear particularly vulnerable. The visual impact is impossible to ignore. Entire towers can look occupied during the day, yet reveal significant vacancy levels after sunset when large numbers of units remain dark for investors. Declining occupancy creates additional pressure. Mortgage payments, maintenance fees, service charges, and operating costs continue regardless of whether a property is generating income. As vacancies rise, profit margins shrink. Some analysts warn that if occupancy levels continue falling, property valuations could come under pressure as investors adjust expectations for future earnings. Others argue that Dubai's long-term fundamentals remain strong and that the current weakness may represent a temporary market correction rather than a structural problem. Either way, occupancy rates are becoming one of the most closely watched indicators in the region because when buildings remain empty, they tell a story that sales brochures cannot. A story about real demand, and right now, that story is raising difficult questions. The effects of declining occupancy extend far beyond developers and construction companies. For property investors, the stakes are significant. Many purchased units expecting steady rental income and long-term appreciation. Lower occupancy rates threaten both assumptions. If rents fall due to increased competition, investors may see returns decline. Some could face difficult decisions about whether to hold properties, reduce prices, or exit the market entirely. Residents, however, may experience a different reality. For tenants, increased vacancy often creates opportunities. Landlords competing for occupants may offer lower rents, flexible payment plans, upgraded amenities, or additional incentives to secure leases. This shift can improve affordability and increase housing choices. Businesses also feel the impact. Commercial landlords may lower office rents to attract companies. While this can benefit startups and expanding firms, it also reduces revenue for property owners. The broader economy becomes interconnected with these changes. Real estate plays a major role in Dubai's economic ecosystem. When property markets slow, related sectors including construction, finance, interior design, and property management can also experience pressure. Yet many observers caution against assuming a worst-case scenario. Dubai has weathered previous real estate downturns and repeatedly demonstrated an ability to adapt. Government reforms, investor-friendly policies, and strategic economic diversification have often helped stabilize the market during challenging periods. The question now is whether those same strengths will be enough to offset growing concerns about oversupply, because the next phase of this story could determine whether current weakness becomes a temporary setback or a more significant turning point. Despite growing concerns, many experts believe Dubai still possesses powerful advantages. The city remains one of the world's leading hubs for tourism, trade, finance, and international business. Its strategic location connects Europe, Asia, and Africa. Its infrastructure ranks among the most advanced globally. And its tax-friendly environment continues attracting entrepreneurs and investors. These strengths could help absorb excess supply over time. Population growth remains a critical factor as more professionals relocate to Dubai for work opportunities and lifestyle benefits. Housing demand could increase significantly. Government initiatives may also play a role. Policies designed to attract long-term residents, skilled workers, retirees, and foreign investors have already expanded Dubai's appeal beyond short-term speculation. At the same time, developers may need to adapt.